price holds lower memory. But the first long is too weak. The session forms inside tight compression. Before any trade, higher time frame comes first. Monthly, weekly, daily, especially weekly. If you do not know the higher map, the 1-hour chart can trap you. You enter late. You chase the move. You place the stop where noise can reach it. You wait for a target that has no real space. So before this trade, the bigger chart must already be in your head. Now move into May 28th Asia session. May 28th Asia session forms above May 28th US session upper boundary. It forms with about 25% compression inside April 16th US session box. It is not wide. It is tight. It overlaps older memory. That matters. A wide session box gives wider support and resistance. But the support is spread out. The reaction can be slower. The stop can become deeper. A narrow session box gives tighter support and resistance. The line can be stronger. The reaction can come faster. But the trade also needs exact timing. May 28th Asia session forms in that tight condition. Price stays inside May 28th Asia session box. It moves inside the box. It tests. It reacts. It does not immediately break free. Then price tests. May 28th US session upper boundary. The level holds for a moment. A long idea appears. Long entry line. May 28th Asia session lower boundary. Stop loss line. May 28th US session midpoint. Take profit line. May 28th Asia session upper boundary. Risk-reward ratio. 1.1. That number matters. The trade may look possible. The lower boundary can hold. Price can move toward the upper boundary. The box is visible. The entry line is visible. The target line is visible. But the trade is still not good enough. A 1.1 risk-reward ratio does not deserve execution. The account cannot survive by taking weak reward again and again. One win does not fix bad structure. One good candle does not fix poor reward. If the stop is real, the target must pay. Here, the target does not pay enough. So the answer is simple. No entry. That is not fear. That is execution. A trader does not take every possible move. A trader takes the move where risk deserves the reward. Now watch what happens next. Price continues inside the session. The long that looked possible does not give enough reward. Then the market shows the better trade. May 28th Asia session later reaches its upper boundary. It tests the upper side. It cannot stay there. Distance becomes shorter. Reaction comes back faster. The upper side begins to fail. Now the short appears. Short entry line. May 28th Asia session upper boundary. Stop loss line. May 27th Asia session lower boundary. Take profit line. May 28th Asia session lower boundary. First trailing target. May 28th US session midpoint. Second trailing target. May 28th US session lower boundary. Third trailing target. April 10th US session upper boundary. Risk-reward ratio. 5.83. Now the trade quality changes. The first long had 1.1. The short gives 5.83. Same chart. Different quality. That is why direction alone is useless. The long looked tradable, but the reward was weak. The short came after the upper side failed. The reward became strong. The entry sits at May 28th Asia session upper boundary. Why there? Because price reaches the upper side and cannot stay above it. The market tests strength. Strength fails. The short begins from that failure. You are not shorting because price is red. You are shorting because buyers fail at the top of a tight compressed box. That difference matters. A red candle can be late. A failed upper hold gives structure. The stop sits at May 27th Asia session lower boundary. That may look strange at first, but the short needs room. May 28th, Asia is tight. The failure happens at the upper side. If price can return above the failed area and move back into higher memory, the short loses control. The stop must sit where the short idea breaks, not where the trader feels comfortable. A tight stop can improve the number, but it can remove the position early. A deeper stop reduces size, but it gives the trade survival. This trade pays because the target path is clear. The first target is May 28th Asia session lower boundary. That is the return through the box. If price fails at the upper side, the lower side becomes the first completion area. Price moves down. It reaches the first target. The trade pays. But the move does not stop there. Now the trail begins. First trailing target. May 28th U.S. session midpoint. The short has already earned distance. Now price can test the next old memory. If price reaches that midpoint and reacts fast, protect the trade. If price breaks through and keeps distance, the next target can open. Second trailing target. May 28th U.S. session lower boundary. This is deeper old memory. Price moves from the tight Asia box into the wider U.S. box. The short still has pressure, but it must keep distance. If pullbacks deepen, protect. If reaction speeds up, protect. If price keeps moving away, let the trail work. Third trailing target. April 10th, U.S. session upper boundary. That is a larger memory target. Price can reach it only if the downside pressure continues. That is why the stop must follow. A target that moves without a stop is only hope. The market already paid. The remaining position must protect profit. Trailing needs a real interval. Do not trail every small candle. A useful trailing move should usually wait for about 0.5 risk-reward unit or more. Less than that often becomes noise. If you trail too early, the position suffocates. If you trail too late, the account gives back too much. So the stop follows structure, not fear, not greed, not the last red candle. Now, trader type matters. An aggressive trader may use a tighter stop. The stop distance becomes smaller. Position size can become larger. Sometimes that works. Price never touches the tight stop. The short pays quickly. But the danger stays real. Normal reaction can touch the tight stop. The structure can still be right. The position can already be gone. A conservative trader gives more room. The stop is not too tight. The position size becomes smaller. The trade survives more noise. The chance of losing the position before the target decreases. But the wider stop must still pass the reward test. If the reward cannot pay, the trade is skipped. Partial profit can help. At the first target, a conservative trader can take 60% and leave 40%. An aggressive trader can take 40% and leave 60%. If the trail reaches multiple stages, a conservative trader can take 50%, then 30%, then 20%. A balanced trader can take 25%, then 50%, then 25%. An aggressive trader can take 20%, then 30%, then 50%. But the percentages do not create the edge. They only manage a trade that already has structure. May 28th, Asia gives the full lesson. The first long appears. The ratio is 1.1. It gets skipped. Then the upper side fails. The short appears. The ratio expands to 5.83. Price returns through the box. Then the trail moves through deeper memory. Same session. Different trade. The first setup tempts you. The second setup pays you. The difference is not direction. The difference is risk. Price reaches. It reacts. It fails to hold. Then the better trade begins. Price pushes up again, but the clock takes the trade away. The session forms inside compressed memory. May 29th U.S. session forms at May 28th U.S. session midpoint. It compresses by about 50%. It overlaps there. That matters. The box is not wide. The decision area is tighter. A narrow box can create stronger reaction, but it can also create a trap. The line looks clean. The trade looks easy. The hand wants to enter. But the session is the last session of the week. That changes everything. May 29th U.S. session first pushes higher. It breaks above May 28th Asia session upper boundary. Then it reaches May 27th Asia session lower boundary. The move looks alive. Price has lifted from the compressed area. It has reclaimed the Asia upper side. It has reached older memory above. A long setup appears. Long entry line. May 29th U.S. session midpoint. Stop loss line. May 28th U.S. session lower boundary. Take profit line. May 28th Asia session upper boundary. Risk-reward ratio 2.06. At first, this looks acceptable. The ratio is above 2. The entry line is clear. The stop line is clear. The target is realistic. But trading is not only numbers. The timing matters. May 29th U.S. session is the final session of the week. Safe trading needs time. A clean long needs space. A comfortable weekend needs less exposure. Here, the trade appears late in the weekly cycle. That changes the decision. The long entry sits at May 29th U.S. session midpoint. Why there? Because the session forms around May 28th U.S. midpoint. The midpoint becomes the decision line. If price holds above it, the long can push toward May 28th Asia upper boundary. If price loses it, the long has no base. So the entry logic is clear, but clear logic is not enough. The trade also needs enough time to move, react, and complete. The stop sits at May 28th U.S. session lower boundary. That stop protects the lower side of the prior session memory. If price falls below that boundary, the long has lost the compressed base. The structure has failed. The stop makes sense. The target sits at May 28th Asia session upper boundary. That target is the first clean old memory above. If price holds the midpoint and moves away, that target can pay. So why skip? Because the last session changes risk. There are fewer candles left. Management time becomes shorter. The market can stall. The trade can remain open too long. The trader can carry stress into the weekend. A valid trade can still be skipped when the timing is poor. That is execution, not weakness, not fear. Protection. Look at the behavior. Price breaks above May 28th Asia session upper boundary. It reaches May 27th Asia session lower boundary. But then the market does not open clean freedom. It pulls back. It rotates. It hesitates. Distance does not keep expanding. Continuation does not stay clean. The trade can still work, but it does not deserve forced entry. Now compare this with May 28th Asia short. The short had 5.83. The move had distance. The targets opened lower. The trade gave room to manage. May 29th US long has 2.06. Usable. But the timing is weaker. The weekend is near. The room is less attractive. The trade requires holding into uncertainty. That is why the best position can be no trade. No trade is not empty. No trade protects the account. No trade protects the next week. No trade protects the method. A trader who skips weak timing still wins the process. Now think about aggressive traders. An aggressive trader may still enter. They may tighten the stop. They may use smaller time windows. They may try to capture the move before the week closes. That can work, but it requires fast management. If price does not move quickly, the position must be reduced. If price returns below the midpoint, the trade must be closed. If the target is not reached before time runs out, the trader must decide quickly. This is not a comfortable setup. A conservative trader does not need that pressure. The conservative trader skips, especially when the weekly session is ending, especially when the move has already tested older memory above, especially when the prior day already gave the better opportunity. That matters. You do not need every trade. You need the right trade. If the day already gave a 5.83 short, the next late long does not need to be forced. Protect the weak. Protect the capital. Protect the method. Now, trailing rules still matter, but only after a trade earns distance. If price reaches the first target and holds with strength, a trail can be considered. But here, the main decision is before entry. Does the setup deserve fresh risk? Does the week allow time? Does the target give enough space? Does the stop protect structure? Does the trade create stress after the close? If the answer is unclear, skip. Trailing cannot fix bad timing. Partial profit cannot fix a forced entry. A good ratio cannot fix a final session problem. That is the lesson. Still, if an aggressive trader takes it, management must be strict. At the first target, protect quickly. A conservative style inside an aggressive trade can take 60% first and leave 40%. A more aggressive style can take 40% first and leave 60%, but only if the price moves quickly. If price stalls, do not pretend it is still clean. If there are two stages, do not wait for perfection. Take profit. Move the stop. Reduce exposure. The weekend does not give unlimited management time. Now step back. If today's movement feels confusing, move to the higher time frame. Monthly, weekly, daily, especially weekly. A 1-hour chart can show the entry, but the weekly chart shows the wall. The daily chart shows the working range. The monthly chart shows the field. If the 1-hour long looks tempting, but the weekly chart gives no space, do not force it. If the 1-hour short looks strong, but the daily chart sits on support, watch reaction. If the session is late and the box is compressed, be more selective. That is why the weekly review matters. Without it, the trader sees only candles. With it, the trader sees where the candles are trapped. May 29th US session gives a visible long. Entry. May 29th US midpoint. Stop. May 28th US lower boundary. Target. May 28th Asia upper boundary. Risk-reward ratio. 2.06. But the final session makes the answer different. The cleanest position is no trade, because time is risk. Weekend is risk. A late entry is risk. The setup may work, but the account does not need it. May 28th Asia gave the better short. May 29th US gives the tempting long. 1 pays. 1 should be skipped. That is the day. Price reaches. It reacts. It holds or fails. Then the trader asks the final question. Does the trade deserve risk now?